we're going to be talking about how to do some basic underwriting things. So when you're looking at an opportunity to invest in a project, you might want to look very closely at the underwriting file before really getting too excited about the deal, and making sure that the underwriting file is conservative, it's accounted for everything, and it's been sort of gone through by your team and maybe a CPA or a financial advisor that's helping you look at the transactions. So with that, we've got the opportunity to look at just some high-level stuff. So 3 things that we're going to be focusing on is the underwriting file, expense ratio, DSCR, and growth rate assumptions. So when you look at, those are the 3 things that we look at up here on the board. And the first thing that you want to look at is expense ratio. Now, when you look at an underwriting file, we talked about the sources and uses yesterday, where all the money comes from, where it's all being spent. And then once the deal is purchased and you have all the funds in your account ready to deploy to buy the property, do repairs, whatever it might be, you then want to get into, okay, what are the monthly expenses that the operator or the deal has accounted for? So what we do is we look at the expense ratio, and to make sure that it's reasonable. So in self-storage, we look at an expense ratio of anywhere from 25 to 40%. So what does that mean? That means that if we have roughly $100,000 of revenue, so $100,000 of revenue. Okay, so this is all of the rent collected. So if you're in multifamily, this is the same thing. It's all of your rents, your 3 bedrooms, 2 bedrooms, 1 bedroom apartments, studios, whatever it might be. In self-storage, it's your 5x10s, 10x10s, 10x20s, whatever it might be. And then and you're taking all of that total rent potential, and you take those items, and then you're going to subtract any expenses that go along with operating the business. So in storage, we have 5x5s, 5x10s, 10x20s. We gather that entire unit mix and say, okay, the total revenue per month or by year will be X amount. So in this example, we're looking at an expense ratio, and we're calculating that by taking the total revenue, so of $100,000, and let's say the total expenses are $75,000. So $75,000. That's your utilities, your property taxes, your payroll, your marketing, your advertising, your expenses at the property to include snow removal or cutting the grass, whatever it might be. So you have a total, we're going to do $25,000. So you have a $75,000 NOI. So your expense ratio here is 25%. And the way you get to that is you take 25,000 divided by 100,000, and you get 25%. So your expense ratio here is 25%. Okay, so is that good or bad? I don't know, it depends. In storage, we use some heuristics that your expense ratio could be anywhere between 25% and 40%. So if you're looking at an underwriting file and you dive in and you say, hey, does this underwriting make sense? What I would do is I would go right in and I would take total revenue and expenses, which is NOI, or net operating income. And I would say, okay, if I take that 25 divided by 100, what is that expense ratio? And if it's 25% or higher, that's usually a good starting point. Now, there's some variables in the market. So let's say you're in a really expensive property tax place, or jurisdiction where property taxes are really, really high. Well, guess what? Your expense ratio is going to go up because you're paying more in property taxes. We have properties where property taxes are $800 a year. We have property tax payments that could be close to $8,000 a month. So it's really important to kind of understand what that ratio is, but 25% is a good starting point. Now, let's say it's 15%. You might want to kind of make sure the operator has properly accounted for everything. Do they have payroll in there? Do they have property management fees? Do they have utility expenses? You got to really make sure they've done their job, done their homework, and they've accounted for all the things that might go. If I see anything less than a 25% expense ratio, I throw the red flag and I say, okay, what's going on here that makes it so efficient? So the next thing you want to do is you want to look at DSCR, and everybody throws this term around. DSCR, again, kind of depends on the project, but the simplest way to calculate this, let's say we have a business that has let's just say $140,000 a year in total gross revenue, and they have $20,000 of expenses. So again, if you did the math here, the expense ratio is low, so I would go right into their expenses and make sure that they've accounted for everything. But in this case, our NOI now is $120,000. Okay, so now the way that you calculate your DSCR, your debt service coverage ratio, is you say, what is the loan payment? So if the loan payment is $100,000, your loan payment's down here. So let's just call it loan, okay? And your loan, let's say, is $100,000. So now you have a new line down here. You have a $20,000. This is what's called net ordinary income, still NOI, but a different term, net ordinary income. And so you would say $100,000 divided by $120,000, you have a DSCR of 1.2. So if you have a DSCR of 1.2, that could be okay, just depends. So the higher the number, the better. So let's say that there was a ton of risk in the project. So it's ground up development, lots of entitlements, and it took a lot of work to get to this to this number. I would probably question it a little bit. You know, why is it taking? Why am I putting all the risk on the table to only achieve a 1.2 DSCR? Probably not a deal that I'd be too excited about. Now, if you were buying the property and it was stabilized and fully occupied and there wasn't a lot of value add going on and your DSCR day one was 1.2, probably not as bad of a deal. Now, let's just, for the sake of example, let's just go ahead and move this NOI number up. Let's just say it was $200,000 a year. So let's say the property, so we'll ignore this for a second, but let's just say the NOI was $200,000 a year and your loan was $100,000. Now your debt service coverage ratio has gone up to 2.0. This is kind of looking a little bit stronger and better for the opportunity. So the DSCR is now 2.0. And you may say, oh, wow, that's a really good DSCR, but you still have to peek behind the curtain and consider, is this a property that is risky? If it has a high DSCR, it doesn't always equal a reduced risk. I mean, it may mean that the property could be produce more income, but it may mean that you have to consider the risks that are associated with achieving that DSCR. Maybe that asset is in a C-class area and it has more vulnerable swings in getting revenue from your tenants. Maybe it's a tough tenant base. Maybe there's a lot of evictions. Maybe there's a lot of turnover. So you have to just look at all the variables that go into DSCR. Now, the last thing I'd look at is growth rate assumptions. Everybody talks about this. People say, oh man, we're conservative underwriters, or are there any underwriters out there that are underwriting rents declining, revenue declining, or is it always roses and rents going up? That's kind of something to think about. And the way that you can simply see that, if the operator doesn't list it and calculate it for you, is you can just simply look at the P&L and say, okay, in month one or year one, let's just say the revenue, the total rents collected is $100,000. So month one, we've got $100,000 of rent. Okay. And in month two, they say that the rent is, for that year, is now $106,000. Obviously, we have, if you take 106 into 100,000, you have a 6% growth rate. So that is a very significant increase in your monthly rent. So I would say, why are the rents going up so much? Is it because they've completed their value add? Have they added additional units? Did they buy the property with rents that were significantly under market value and it's just showing that they're bringing those rents up the market value? Or is it, has the business plan been executed and all the value has been added to the property? This is many, many years down the road, and they're just saying, oh, the rents are going to just go up and up and up and up and up every year. It's something to consider. Might want to throw a red flag if it's a market that doesn't have population growth projections or something exciting surrounded it, like a new employer comes into town, or maybe it's a high traffic area or a good property that's just going to continue to rise with the economy. But I would question a 6% growth rate, obviously, or anything more than a 1 or 2%, if you're just assuming that that's what the market is going to take it. So I hope this was helpful, everybody. We'll be doing another one on Monday right here at 4 p.m. Pacific time. We're focusing on the things that we look at in underwriting. So we'll dive in and continue to talk about maybe your unit mix and a couple of the things in the financial underwriting for a project. Thanks for watching.